Welcome to Corporate Finance. Welcome to session 12 of Introduction to Corporate Finance, a very exciting session on lessons from capital market history. What can we learn from the capital markets and what has happened over the last 90 plus years in terms of ROI of various instruments? So we'll look at history and we'll look at the future a little bit. The first learning objective is how do we speak about our returns? Do we talk in dollars? Do we talk in percentages? And what has this historical record told us? Doctors Ibbotson and Sinkfeld have looked at the last 90 plus years of stock market returns, bond market returns, T-bill returns, and also interest rates. What have interest rates done over the last 90 plus years? This is the topic, the research that Doctors Ibbotson and Sinkfeld offer us in session 12. How do we do average returns, and what advantage can we get out of looking at averages? What is the average return on a large company stock over the last 90 plus years? How about small company stock? How about corporate bonds? How about government bonds? And then you can use these data to make some decisions on what you want to invest in your first day of work. When your HR rep will typically have you down on the first day for onboarding, and they'll ask you, what kind of investments would you like to make in our 401k plan? We offer large company stocks, small company stocks. We offer corporate bond fund. We offer government bond fund. We offer just a money market account and a T-bill account. So what would you like to choose? And please let me know by noon today. It's 8 o'clock in the morning. Please let me know by noon. And you can't change those choices for 6 months. So you can use some of the data from this session to help you make good decisions on what you want to invest in according to your risk preference. And how can I look into the future and try and predict what returns will come into the future? How about calculating the variance of any particular instrument and the standard deviation? And what does that tell you? Plus or minus one standard deviation from the mean. 2/3 of all future returns will fall within that band. Plus or minus 2 standard deviations from the mean. 95% of all future returns will fall within that band. And plus or minus 3 standard deviations of the mean. 99% of all future returns will fall within those bands. Our final learning objective in session 12 is capital market efficiency. Do we deal with efficient capital markets? And what is an efficient capital market? Where all available information is reflected in the stock price. You will find session 12 to be very, very interesting and very useful to your investing life. Total dollar return, when we talk about our investments, we'll talk about total dollars taken in, dividend income plus capital gains. Capital gain being simply price appreciation, aka price appreciation. How do we calculate dividend yield? It's a very important ratio, D1 over P0, or generally D sub T plus 1 over P sub T. Capital gain yield, as I said, is just price appreciation, new price minus old price over old price. This really holds if you're looking at pricing up and down in any market, in advertising and product sales. If your price goes up, P1 minus P0 over P0. In advertising, if your price goes down, P1 minus P0 over P0 will always get you the right percentage. You can't just divide the two prices. You must do it this way. Total return is my dividend yield, calculate above plus my capital gains yield. So we like to talk about percentages. So very frequently, rather than talking about our total dollar dividend and our total dollars made and price appreciation, we like to talk about percentages. I made 48% on that investment. Then everyone wants to know what you invested in. Average returns on these investments are simply the summation of all the returns divided by the number of returns. So if Ibbotson and Sinkfeld did this for 94 years, you take all the returns, add them up, and divide by 94. The variance is just the sum of the squared deviations divided by T minus 1 observations. Small sample size, divide by T minus 1. If you have a large sample size, you divide by T to get the variance. And standard deviation is a very important calculation. It's just the square root of the variance that you just calculated in the prior step. There is a substantial reward for bearing substantial risk, and the greater the reward, the greater the risk. So if you see some instruments promising you 25%, be very wary, because you'll see some of these average returns on these more common instruments peak out at about 17% on average. So if you see higher numbers than that, be very, very wary. Let's talk about returns on investment. First learning objective. Return on investment is what kind of money did I gain or lost? You might have a negative ROI from an investment. The income component is typically dividends. Cash received each and every year while holding that stock would be a good example. And then capital gain is my price appreciation. P1 minus P0 over P0. What is the gain or loss from the change in value of that stock, if it went up, if it went down? So if I take my dividend income plus my capital gain, that will be my total dollar return. But again, people don't seem to get too excited about that. They like to talk about percentages. So we're going to look into calculating percentage returns. Dividend yield is simply D sub t plus 1 over P sub t. So annual dividend divided by today's stock price. D1, annual dividend, over P0, today's stock price. And then capital gains yield is new price minus old price over old price. P1 minus P0 over P0, or generally P sub t plus 1 minus P sub t over P sub t. Looking at this pie chart, you can see my total percent return is dividend yield, which is usually the smaller part, and your capital gains yield, which is the larger part of the pie. That's how you calculate it, very, very simply. Here's a good example. You bought a stock at the beginning of the year for $25 a share. At the end of the year, it's worth $35 a share. You're a very happy investor. To make even happier, you also got a $2 dividend per share that you owned. What is the dividend yield? What is the capital gains yield? And what is the total percentage return? If you invested $1,000 in this stock, how much do you have at the end of the year? So we'll talk about dollars and we'll talk about percentages, but we seem to like to talk about percentages more. So we'll calculate the total percent return by adding up the dividend yield plus capital gains yield. So here's kind of a graph of what happened. I got a $35 stock price end of year. I paid $25 at the beginning of the year, and by the end of the year, I received the full $2 dividend. So what was my total return? D1 over P0 plus P1 minus P0 over P0. So my dividend yield is 2 over 25 or 8%. Nice, healthy dividend yield. My capital gains yield is phenomenal, 35 minus 25 over 25 or 40%. In total, I got a gain of 48%. So I'm a very happy investor. My $1,000 would have jumped up to $1,480. And you kind of say, oh, okay, $480, that's nice. You say 48%, everyone jumps and starts screaming, oh, wow. So we tend to like to talk about percentage gains. Here's another good example. Let's say you bought some Tesla stock, let's say at the end of 2020, beginning of 2021, or $609.99 a share. At the end of the next year, it's selling for $9.91 a share. I also get a $2 dividend per share. Am I a happy investor? What's the total return on this Tesla stock? So there's a similar graph to what happened to your stock. You bought it for $609.99 and you sold it for $991.70, got a nice $2 dividend to make you even happier. So I can very simply calculate the total return, dividend yield plus capital gains yield. My dividend yield is very tiny percent, 0.32% because of the high stock price. But my capital gains yield was a very, very healthy 62.58%, $991.70 end of year minus $609.99 beginning of year divided by beginning of year, and I get almost 63%. Most of that is capital gains yield, a little bit of dividend yield. Either way, 63% total return. My $1,000 would have turned into $1,629. I had a very good year in that one stock.